Have you ever wondered why financial ratios are important in managing an architecture firm? In this video, we delve into this topic, shedding light on the significance of these numerical values. Financial ratios, in essence, are key performance indicators, or KPIs, used to provide insight into the financial health of your architectural business. They give you insights into your firm's profitability, liquidity, efficiency, and financial structure. For instance, a simple equation like revenue minus expenses equals profit can reveal whether your firm is making money or running at a loss. In preparing for the Division 1 Practice Management exam, understanding these ratios is crucial. You'll encounter terms like the current ratio, which gauges your firm's ability to meet current obligations, or the overhead ratio, which should ideally fall between 1.3 and 1.5. These ratios, and others like the net profit before taxes, quick ratio, revenue per technical staff, and revenue per total staff, each hold unique value for your business. Understanding these financial ratios is not just about passing exams, but also about effectively managing your architecture business. Now, let's dive into the specifics of each financial ratio, starting with the basic equation: revenue minus expenses equals profit. This is the most fundamental financial equation. By subtracting your expenses from your revenue, you can determine your firm's profitability. Moving on to the current ratio, this is calculated by dividing total current assets by total current liabilities. It essentially measures your firm's ability to meet its short-term obligations. Generally, the higher the ratio, the better. A healthy business usually has a current ratio of 1.5 or higher, and 1.0 is about the bare minimum acceptable level. Next up is the net profit before taxes. This is not so much a ratio, as it is a percentage of profit based on net revenue. It provides a snapshot of your firm's profitability before taxes are factored in. The overhead ratio is the total office overhead divided by total direct labor. This ratio should ideally be between 1.3 and 1.5. It gives an indication of how efficiently your firm is utilizing its resources. The quick ratio is a refinement of the current ratio. It includes only cash and cash equivalents, plus accounts receivable, plus revenue earned but not billed, divided by total current liabilities. It is a more stringent measure of a firm's liquidity. Revenue per technical staff is the amount of revenue produced per technical staff members. These are the staff members most directly involved with charging direct time and producing jobs. This ratio can provide insights into the productivity of your technical staff. Lastly, the revenue per total staff is the annual net operating revenue divided by the total number of employees. This includes principals and part-time employees. It gives an overall picture of the revenue productivity of your entire staff. Each of these ratios offers a unique perspective on the financial health of an architecture firm. Understanding them can provide valuable insights into your firm's financial performance and help you make informed business decisions. With a better understanding of each ratio, let's summarize the key points and their importance in managing an architecture firm. First, we have the fundamental equation that governs all businesses: revenue minus expenses equals profit. This is the backbone of your firm's financial health. A healthy profit margin allows for growth and stability. Next up is the current ratio. This is your firm's ability to meet its short-term obligations. A number above 1.5 suggests a strong financial position, while a ratio around 1 indicates a firm just scraping by. The net profit before taxes percentage gives us a clear picture of your firm's profitability relative to its overall revenue. It's a key indicator of efficiency and financial health. The overhead ratio is a measure of how well your firm manages costs. Keeping this ratio between 1.3 and 1.5 is a good rule of thumb. The quick ratio refines the current ratio by focusing on the most liquid assets. It's a more stringent measure of your firm's short-term financial health. Revenue per technical staff measures the productivity of your most crucial employees, those directly involved in charging direct time and producing jobs. Lastly, revenue per total staff gives a broader view of productivity, including all staff members. It's a great way to gauge the overall efficiency of your firm. Remember, understanding these ratios is not just about passing exams, but also about effectively managing your architecture business. So, now you know why financial ratios are integral to architecture business management. They're not just numbers, they're the pulse of your firm's financial health. From the current ratio to the overhead ratio, each one offers a unique insight into your firm's performance. They allow you to make informed decisions and steer your business towards success. So don't stop here. Dive deeper, practice more, and master these ratios. Keep studying, keep preparing, and remember, financial ratios are your friends in architecture business management. Good luck on your exam.